Hello, this is David. Welcome to the Focus Review, Part 1, first of 8, and that means it refers to a focus review of the Foundations topic. And about these focus reviews, the goal here is certainly not to give you a comprehensive review of the concepts. You'd want to see the regular video series for the detailed aim-by-aim coverage. However, one of the challenges of the FRM, a key challenge, is that there's so much content. We know that there is more content than topics that can possibly be tested on the exam. And so instead the goal here is to complement your regular study. So I emphasize this is a complement to a regular study, not any kind of replacement. It's certainly not comprehensive to replace anything. Where our goal is to just do a very brief, concentrated review of selected key ideas, sort of an 80-20 rule. And related to that, just to review some archetypal questions and answers. So I have deliberately selected some sample questions that I think really represent key ideas you need to know for the exam. So we're in Foundations, the first of 8. I've taken this part 1 and sliced it up into 8 sections. We start with Foundations, and that means the key ideas here, in my opinion, are the risk typology, capital asset pricing model related to portfolio theory, value at risk, VAR. That's just because that's really the key risk measure. At least here we are in 2012. VAR is the key risk measure in the FRM and has been for several years. Maybe that'll change going forward. Certainly we complement it with some more sophisticated measures like expected shortfall. But really we need to know VAR. We need to know how to compute it, we need to know its strengths, and we need to know its weaknesses. Briefly, creating value with risk management, because the author Stolz appears, risk-adjusted performance measures, and then I'll mention cases briefly. So I think those are the key ideas in Foundations. And now the practice question sets that have all been freshly revised for 2012, including these 5. So here's a snapshot in the study planner. Notice we've got this icon with the question mark. That indicates practice questions. So these are each PDFs and freshly revised to incorporate some of the feedback and even some of the forum discussion in some cases. So I'm really happy with the updated quality of these. But notice we've got a question set for Jorian, Stolz, Elton, Emick, and the cases. As before, we have learning spreadsheets associated with the Foundations topic. And then let's take a look at some of these key ideas. First, the risk typology. So this is Jorian's. I re-rendered one of his diagrams from the VAR handbook that I think is helpful. Notice we have firm-wide risks, distinguishing between business risks and non-business risks. And that means that business risks include, for example, strategy, macroeconomics, technology as part of the business environment. And so these are risks that generally are excluded from our review. So that includes notably strategy. And then firm-wide non-business risks are divided into financial and non-financial other. Notice in non-financial other we've got reputational risk. And so we can see that just schematically, strategy and reputational risk are excluded from our typical definitions, including operational risk. That's my point to share this diagram with you, is to remind that operational risk does not nearly include all risks. And classically in the FRM, popular exam questions does not include strategy and reputational risk, but does include legal risk. And so we are primarily concerned with financial risks that are non-business. And those financial risks here are the 3 big buckets: market, credit, operational risk. And then operational risk includes legal risk. So legal risk is an operational risk. And then opinions can vary here as to where we locate this, but Jorian has liquidity risk and market risk as well. Okay, for modern portfolio theory and capital asset pricing model, we absolutely need to know, because it will be tested in one form or another, the expected return on a portfolio of 2 assets. So that's the example I have here. if the portfolio is weighted 40% and 60% with assets that respectively have an expected return of 10 and 16%, it's a weighted average. We absolutely need to know how to calculate the volatility of a two-asset portfolio of risky assets under this mean variance framework, where we have the volatility here is the square root of the term inside the brackets here, which is the variance. And then importantly, this final term of covariance is equal to the product of the correlation and the respective volatilities. So you need to be very handy with this substitution here. For example, asset 30%, a portfolio with asset 30% in A, 70% asset B, respective volatilities or standard deviations, if you like, of 10 and 20%, and then a correlation denoted by Greek rho between those two assets of 0.30. This correlation is unitless. That means the covariance is the product of volatility 10%, volatility 20%, and correlation 0.30. That gives us the covariance. We can plug these in. Inside the brackets is the two-asset portfolio variance. Square root of that is that two-asset portfolio volatility. So that Eldon is a lot about the modern portfolio theory assignments. All the more theory than we need to know for the exam, certainly. This is illustrated in the capital asset pricing model learning spreadsheet. Here's the two-asset portfolio, where each of these red lines represents a different correlation. Red is perfect correlation, and so we can see that anything less than perfect correlation, that is to say imperfect correlation, and we start to realize the benefits of diversification is illustrated by the curvature here in this line between the two assets. So it is imperfect correlation that really manifests as the benefits of diversification. So here we have the portfolio possibilities curve, which Eldon says must be concave. And notice here, this line represents, first of all, a plot of expected return against standard deviation, and it's the set of minimum variance portfolios. So that is to say, for each expected return, here is the minimum variance, which would also correspond to the minimum standard deviation. For example, here given a return of 5%, 8.5% is the minimum variance. So we call this the portfolio possibilities curve or set of minimum variance portfolios, such that there's a single point furthest to the left that Eldon calls the global minimum variance portfolio. See how it's global. The global indicates it's the one point. This will not be the most efficient portfolio. The most efficient portfolio will be somewhere up here. It will have the highest Sharpe ratio. And so we have the portfolio possibilities curve, where the efficient frontier is the upper region of that concave plot. Again, standard deviation in the x-axis. So here we've got an efficient frontier, and then we introduce the risk-free rate right here at 6%. We can think of that as an anchor of this blue line that becomes a point of tangency here at that highest efficient, most efficient, highest Sharpe ratio portfolio. And now we have really a capital market line that becomes the efficient frontier, because you can see it's superior here to previously efficient portfolios on the green line. So this is our capital market line. It is now efficient, and you'll notice I like to keep in mind here the x-axis is the standard deviation. The capital market line is a set of optimal portfolios. So the key idea here is it's a linear combination, or if you like, an asset allocation between only two things. right? Only two things. It's not a mix of different assets. Here in green are combinations of risky assets. But among these combinations in green, the market portfolio here in red, the market portfolio, capital M, is most efficient, highest Sharpe ratio. So that's the point of tangency. And then the theory here is that the optimal decision is between an allocation between that market portfolio and the risk-free asset, just those two. Moving along the line, moving along the blue capital market line, is just an asset allocation decision between the risk-free asset and the market portfolio. So that market portfolio is one combination or one relative proportions of the various risky assets. Then the capital asset pricing model is actually illustrated by not that capital market line, but the security market line, SML. Notice what changed here, not really the y-axis, it's the x-axis. Where in the capital market line we saw that that was a volatility here, or volatility which would be total risk. Here it's just beta, which is a measure of systematic risk. So that's when we go from the capital market line, which really had total risk in the x-axis, to the security market line where we have beta in the x-axis. And then the security market line here illustrates here, or manifests if you will, the capital asset pricing model, which tells us that the expected return on the asset is a function of its systematic exposure to the single common factor, the market return premium or excess or equity risk premium. And so here's a question I wrote that, it's at least average or above average level of difficulty for part one, but you really need to master this kind of question because this is a very typical kind of question for the FRM to ask you in order to measure your understanding of that modern portfolio theory. But I like this question that I wrote because I also mixed in the value at risk. So really you have to pause here and make sure that you have a mastery over this kind of question because it brings in a few ideas here. We have a portfolio with two securities, what I call low profile and high beta. Each has an annual return, and then the portfolio is equally weighted. We could change these weights, but here they're 50-50. And then we're given a covariance matrix. That is to say, 0.012 is the covariance between high beta and low profile, or their respective returns. That means, what's the cell right here? The 0.01, that's the covariance of A with itself, which is equal to the variance of A. So here's our covariance matrix. We're told then the security returns are normally distributed independent over time. If the portfolio values 1 million and there are 250 trading days per year, which is nearest to the 10-day 99% confident portfolio value at risk. So on the exam, you would be given 4 options. I didn't include those here, 4 choices. I don't include those because we don't need those to understand how to do the question. But here, pause the video and definitely see if you can work that question out yourself. Okay, so for one thing, it turns out for relative value at risk, or VAR, we do not need the annual returns. If we were computing an absolute VAR, we would. For relative VAR, we don't need them. So we need the volatility of the portfolio. Well, here is the annual variance of the portfolio. So that just applies that formula for the 2 asset portfolio variance. So these are per annum figures here. And then if we take the square root of that, our volatility per annum for the portfolio should be about 13.6%. And now, so that applies the essential formula of our modern portfolio theory. And then we conduct that calculation to find the 10-day 99% confident VAR. And that's right here. It's a product here of four values. Absolutely need to understand this. We've got the volatility of the portfolio per annum. Remember, we want a 10-day VAR, so we need to scale the volatility to a 10-day volatility with the square root rule. Multiply by square root of 10 divided by 250. This multiplication here, scaling by the square root rule, takes advantage of that assumption that these are not autocorrelated returns, that they are independent and identically distributed. We require the IID assumption to do that. Okay, so that multiplication here just gives us a 10-day volatility, which we then scale to get a VAR. Parametrically, VAR is just a scaled volatility. By 2.33, because we're assuming normality, and 99% one tail corresponds to a 2.33 deviate. That gets us a VAR, a 99% 10-day VAR in percentage terms, which that is a fine answer in percentage terms, but we can also multiply by the portfolio value to give us a dollar amount. In this case, about $63,000 and change. Okay, next, Jorian's value at risk. Obviously an essential idea. VAR is the worst loss over a target horizon that will not be exceeded with a given level of confidence. Therefore, that means, on the other hand, that we do expect the loss to exceed the VAR, 1 minus confidence percentage of the time, or a significant percentage of the time. So we could state that, for example, under normal conditions, the portfolio daily loss will exceed the VAR of 3.6 million 1 out of every 20 days. Notice how we've represented here in the affirmative, which is to say VAR does expect to be exceeded at least or approximately 5% of the time if it's a 95% confident VAR, and here is our horizon. And so you'll notice there was actually a sample question this year with GARP where the back test on a 95% VAR showed that there were no days on which the VAR was exceeded. And that actually ends up being a problem. That implicates the VAR as a flawed model, which is another way of saying that, keep in mind, VAR does expect to be exceeded. That's part of the probabilistic statement. There's two decisions, confidence and the time horizon. So 95% one day is very common. So the other confidence is 99%, and the other common horizon is 10-day. So for market risk VAR, very common is 99% confidence over a 10-day horizon. But we want to be very capable of scaling between them. And so from the spreadsheet here, 1A1, an introduction to VAR, I've got that right up front as 1A1 because it's so fundamental, at least to the FRM, where we've got the single asset delta normal VAR. Make sure that this all makes sense. Same process as before, asset value, volatility per annum. Typically as inputs, it's much easier to expect and to deal as in our inputs in terms of per annum, so 10%. And then we ask, okay, what is the VAR over 1 day horizon? 95% confidence. 95% confidence corresponds to a one-tailed deviate of 1.65. So that's our normality assumption. Doesn't have to be a normal distribution. If it were a different distribution, we'd have a different deviate. VAR does not imply a normal distribution, but at the beginning, we tend to deal with it because it's familiar and easy to learn that way. And then we've got VAR per annum, volatility times deviate, which we can express that VAR in percentage or dollar terms. And then the per annum scaled into the daily based on some trading days per year, applying the square root rule. Keep in mind also that if we have a 1 day VAR of 2.33%, so then if we scale that to 10 days, we just multiply by the square root of 10 over 1. In that case, we'll get a 7.36%. As I said, that assumes importantly IID. For example, if the independence was violated such that there were positive auto or serial correlation between those returns, then, for example, the VAR would be a higher. In this case, this is actually true. If the autocorrelation is 0.3, you can see the 10-day VAR is actually 9.69. Okay, so that's the parametric or analytical VAR. The other common VAR, in fact, in practice, more popular, we know from surveys, is historical simulation VAR. In a way, much more straightforward because it's a sort in the plain vanilla version of the daily returns. And so here's an example. This one I selected from GARP's sample practice exam, I think 2011. You are the risk manager of a fund. You're using the historical method to estimate VAR. You find that the worst 10 daily returns for the fund over the period of the last 100 trading days are, and then the list of the 10 worst daily returns. So for example, it looks like the worst day was a 3% loss. So there's an actual question, what is the daily VAR for the portfolio at the 95% confidence level? Go ahead, hit pause. And then if we sort these from worst, the worst is negative 0.3%. We know there were 100 trading days. So 1, 2, 3, 4, 5. The worst 5 right here are in the 5% tail, 5 out of 100. And then if we follow down, which I think we should, we want to set the 95% VAR here at actually this 6th worst. And so the answer here really should be negative 0.7% is the 95% VAR. Again, why is that? Well, that's because we had 100 trading days, and here are the 5 worst. If you think about this as a distribution, here's the 5% tail. For Stolz on risk management and how it adds value, we know this chapter in Foundations is notoriously difficult for candidates. It's a difficult read. I'm going to boil it down here. And the idea is simply that if financial markets are perfect, Stolz first asserts in Chapter 2 that risk management cannot create value. Okay, so we start with the premise that risk management cannot create value, but that's in perfect financial markets. So Chapter 3 is concerned with the imperfections, or what he calls frictions, that allow for risk management to create value. So the answer is that risk management can create value due to market imperfections or frictions, specifically in, for example, capital structure, taxes, and agency costs. And so here's a question I wrote that I think teases out this concept from Stolz. In each of the following cases, according to theory, a good risk management program should create firm value, except for which of the following cases? So we have A, the program reduces idiosyncratic firm-specific risk while the firm depends on a large active shareholder who is not diversified. B, the program hedges the firm's exposure to oil prices, for example, as an illustration of a common systemic risk factor with a short position in oil futures contracts. C, the program reduces the volatility of taxable earnings, effectively avoiding progressively higher tax rates and higher tax brackets. And D, the program reduces the debt overhang, which causes shareholders to avoid positive net present value projects. Now, admittedly, I've used very specific language from Stolz to throw as many of the examples at you as possible. Go ahead and pause and think about that. Okay, so very deliberately, the exception is supposed to be B. This is where risk management, in theory, should not be able to create firm value, and that's because this firm is owned by shareholders who are well diversified. So that fits into the picture of perfect financial markets. And basically, Stolz says when markets are perfect, including shareholders who are well diversified, that risk management doesn't have an opportunity to earn value, to add value, either through reducing idiosyncratic risk because shareholders won't pay for that, or through systematic risk because in theory the cost should be equal to the benefit here. And so this A is a deliberate exception to that because there's a large active shareholder like a private equity firm where there is value to that shareholder by reducing firm-specific risk. They're not well diversified. Okay, risk-adjusted performance measures. So we know these are popular items for testing. We have Traynor, Sharpe, and Jensen's. Please notice in the numerator, excess return. Difference here between Traynor and Sharpe is the measure of risk. So these are measures of return per unit of risk, where the key difference here is what kind of risk. Traynor is beta, the systemic risk. Sharpe is the total risk or volatility. And then Jensen's here is related to Traynor because it really gives us the alpha, or the difference between the excess return and what would be predicted by the capital asset pricing model. And then here we have the motivations for when these would be appropriate. Traynor, if it's a well-diversified portfolio, and Sharpe if it's not a well-diversified portfolio. And then we have tracking error. So that's going to be the standard deviation here of what would be the active return here, the difference between return in the portfolio and the benchmark. And then the information ratio here is really, we can have two different flavors of this, okay? So this is a common thread. This is talked about in the forum a lot. Unfortunately, I can't tell you that one or the other is superior. Either we want active return divided by tracking error here, or we could have residual return divided by the standard deviation of that residual return. And then the Sortino, which has minimum accepted return, MAR. And so 1B3, risk-adjusted performance measures. There's my spreadsheet example that illustrates some of these concepts. We have a portfolio with expected return and volatility, beta. And then here, just assume a tracking error. You want to be able to look at these and compute the Traynor. So hopefully you're comfortable enough to know that we're going to have a numerator here in both cases of Traynor and Sharpe of the expected return minus the riskless rate. So this portfolio is expected return of 14%. What's its excess return? It's 10%. That's in the numerator. Then for the Traynor, what's in the denominator is beta. So we've got 10% divided by 1.5. You'll notice that's 6 2/3%. For Sharpe, it's the 10% in the numerator divided by volatility in the denominator, 20%, or 0.5. So you see how those we want to be handy with those two. And then the Jensen alpha. Well, what would be the performance of this portfolio predicted by the capital asset pricing model? Well, it would be a beta of 1.5 multiplied by the market's excess return here of 6%. So 6% times 1.5 is 9%, plus the riskless rate of 4% gets us 13%. This portfolio with a beta of 1.5, capital asset pricing model tells us should have a return of 13%. But it's returning 14%, so its alpha here, its Jensen's alpha, is 1%. And then the information ratio takes that alpha of 1% and divides it by the tracking error of 3%. 1% divided by 3%, or 1/3. So just be comfortable with those four ratios that I just calculated or just showed. And then here's a question here from GARP's 2012 sample, question 20. Portfolio A has an expected return of 8%, volatility 20%, and beta of 0.5. Assume that the market has an expected return of 10%, a volatility of 25%, and also assume a risk-free rate of 5%. And what is the Jensen alpha? What is the Jensen's alpha for the portfolio? Go ahead and hit pause. Okay, and then GARP is a little sneaky here, throwing in, I think, some volatilities that we don't really need. Jensen's alpha. We take the portfolio 8%, and notice what are we subtracting? We're subtracting what the portfolio's return be would be attributed due to its systematic exposure, or beta. Beta of 0.5 times the market's excess return of 5% plus the risk-free rate of 5% tells us here, this looks like this should be 7.5%. So the portfolio's beta of 0.5 implies a 7.5%. We're 0.5% above that. That's our Jensen's alpha. Notice GARP is sneaky. We didn't really need the volatilities here of either the portfolio or the market return. Although if we weren't given the beta, we could be given the volatilities and the correlation, because we should be able to get the beta from the correlation and the cross volatility. And then finally, for case studies, difficult to say what we need to know here. I think we just have to dive into these. Alan divides them into misleading reporting, unexpected market moves, and conduct of customer business. I will tell you that historically, the FRM has favored these two cases here because they're prominent, visible examples of some risk failures. So I think maybe we've seen a sample on Barings or Allied Irish Bank, but really most have been a long-term capital management or Meta-Gesellschaft, where we have key factors here and lessons learned. And then Meta-Gesellschaft, a personal favorite of mine because it's so instructive, where the company was really engaged in an underlying exposure of being a short position in an essentially long-term forward contract with its customer, and hedged those with a stack and roll of long positions in short-term futures contracts. So the underlying exposure was a short position in long-term forward contracts or obligations to customers, hedged with futures contract, where the oil curve shifted from its historical backwardation into contango. In that backwardation, a stack and roll is creating money, is profitable on the roll return, right, as this forward price chases up to the spot, and suddenly that roll yield becomes a money loser in the shift to contango, the roll yield specifically. So a good example of basis risk, liquidity risk, and operational risk. They were these losses, because our futures contract were marked to market, were daily settlement, were immediately realized, and they could not, accounting-wise, book those gains, associated gains on the forward contracts. So the stack and roll hedge exposes them to basis risk, a shift to contango contrated losses on the roll return, and accounting standards required recognition of future losses but not future gains. But not forward gains, I'm sorry. And then a question I wrote, which of the following factors at least contributed to the disaster at Meta-Gesellschaft? A, failure to deliver on a few high-profile customer contracts incurred unexpected reputational risk. B, basis risk implied by short-term hedges against long-term exposures. C, roll return on long futures contract was negative under contango. And D, unlike forwards, futures contracts required daily cash settlement. And you can see I wrote these very specifically so that B, C, and D really do highlight three of the different failures here. That basis risk, which is epic and always manifest in a hedge. That roll return that becomes a money loser in the shift to contango on the commodity curve. And the fact that futures contracts require daily cash settlement. I like this case because it's a dense cluster of ideas here, even in as we go into the whole topics in topics 3 and 4. So A is really the one that does not apply here. So that's the false answer. And that really concludes the focus review of foundations. I hope you found it helpful. I think in a short period of time, it really covers a lot of what you need to know. Thanks a lot. I look forward to sharing focus review number 2 with you next time.